Welcome to this section where we'll be talking about inventories, LIFO, FIFO, costing, what we include in the inventory valuations, what we need to exclude. We'll be talking about a lot about inventory in this section and all the different facets of it. Inventory is any purchased or manufactured goods that are used for resale in our business. They're typically classified as current assets on the balance sheet. So examples of this would be, if you were Home Depot, would be the tools that you have that you would sell, or the lumber in the lumber yard at Home Depot, or those orange buckets that they always sell. Those are the things that would be considered inventory for Home Depot. Grocery store would be dairy products, meat, baked goods. Auto dealer would be cars. These are the things that would be counted as inventory in businesses. And we've accounted for these things in journal entries. And so just as a reminder, how we account for journal entries for inventory leaving the business. I mean, buying inventory is fairly easy. We pay cash, and then you credit cash, and then you debit the new inventory assets that you have. But when you sell inventory, the journal entry that we've done in the past is inventory. You'd have inventory on your books of $20,000, and you'd want to show that inventory leaving. And so you would credit that. So that prior entry was not one that we'd put in. It'd be one that exists showing the balance. We'd have an entry to show that we were crediting our assets when this inventory's gone, because we don't have that asset anymore. That's a resource that's no longer in our possession. We'd credit the inventory, and we'd have a credit journal entry. And then we'd account for that with a cost of goods sold on our income statement for $20,000. And we'd have a debit journal entry for cost of goods sold for $20,000. And this was fairly straightforward. As we get more into inventories, we realize that inventory is actually quite complex. There's different aspects of running a business and creating inventory that make these things a little bit less straightforward. So we're going to talk about capitalizing or expensing some of the resources we use in creating or transporting our inventory. So there's this word that we have that we use in accounting called capitalize. Capitalize means you take whatever resource that you had, and if it's creating something else that you still control in the business, it actually goes back to the balance sheet. So if you had raw materials that you transformed and made something in process with it, say you manufactured little wood figurines, and you had a bunch of wood and you carved up the wood. You didn't finish it, but you carved it up. And so you lost some of the resource that you carved off. You still have a work in process inventory there. That's the type of thing that we're talking about. So capitalizing means is that when we lose some aspect of a resource and transform it into another, we credit that aspect of the resource and we debit a new asset that is usually a work in process or a finished good type of inventory. To expense it, certain expenses we have related to inventory do not get capitalized. By rules, they don't get capitalized. And we'll talk about the general idea. So costs to include. So the costs that should be included when we capitalize are all costs of purchase, costs of conversion. That means cost of converting the raw materials into the finished good. Other costs incurred bringing the inventories to their present location and condition. So if you have costs associated with getting your inventories to the point that they can be sold, that's what you're looking for. The costs that we do not include, so we exclude these costs in what we capitalize, meaning we expense them, are abnormal costs incurred as a result of waste materials. Any storage costs that's associated with the production process, what would that, any storage costs, unless it's associated with the production process. What do we mean by that? If you're storing your inventory off-site because you just don't have space, that wouldn't be something that you would capitalize. However, if what you sell needs to be aged in some way, there needs to be a time period for it to ferment. Say you sell alcohol and it needs to, be in a barrel, or you sell cheese and it has to, get certain mold over time or something like that. That's part of the production process, the storage. So you would capitalize that in that case, but you wouldn't do it for just general storage. And then any administrative overhead and selling costs are not included in what we would capitalize. They get expensed in the period. And so it's important to understand the journal entry difference between capitalizing and expensing. And so we'll go through that really quick. So capitalizing inventory conversion costs. So the example I'll give you is, let's say we had raw materials of $5,000. Well, we ended up using those raw materials and to try to create our inventory. And when we did that, we lost our raw materials. Those raw materials don't exist in that state anymore, and that asset is now gone. We have to show that it's gone. And some of you might say, well, wait a second, hold on. It's not really gone, it's just different. Isn't that kind of like what we would do with cash and like a prepaid expense? Well, you're right. If we prepaid an expense, we don't have that cash anymore, but we'd get a new asset. In this case, it's a similar thing. With raw materials, we don't have those raw materials anymore. And so we need to credit those raw materials, but we do have something else, a new asset that has been evolved. And so we would credit that new work in process inventory of $5,000. Now, some of you are saying, well, isn't it worth more because we put more into it or we did something to it? Remember, we keep these assets at historical cost. So if we spent additional money to upgrade it, then we would probably capitalize that additional money. But in this case, we had raw materials and we're just assuming that they transformed into this new inventory. So increased in value, it's certainly increased in value, but we're not going to mark it up just yet. And the reason why is because eventually we'll mark it up when it's sold. So we keep it at the cost of those raw materials and any additional costs that would be included to capitalize. But those additional raw material value is what we're going to carry it at. And so we would debit those assets and the debit work in process inventory, work in process inventory for $5,000. This is how you capitalize. Capitalize means you take something, a resource that you had, and then take that off the books and then put a new resource back on that has been some sort of conversion with that. All right. Now we're going to go over an expense. All right. So this is an expense example. So sometimes you spend money on your inventory and that inventory expense is not something that we would capitalize based on it not being needed generally for the part of the inventory. So let's say we had cash of $5,000. And so let's say that we had to spend an additional $5,000 on our inventory to actually store it off-site. It has nothing to do with production. We just go to the local, store and lock-up place, and we say, okay, we're going to rent a part of this place and put our inventory in there. And we're going to do it because we just can't afford to get new square footage. So this is going to cost us $5,000 this year. Well, guess what? That $5,000, we don't have that anymore. So we got to credit that. So it's going to cost us $5,000. That's going to be taken off the balance sheet as we pay for it. So we pay $5,000 and we credit that. Now we need a debit. What are we going to debit it? Well, remember, storage costs that are not related to the production, those need to be expensed. So we're going to expense those for $5,000 and it's going to be a debit the expense, and that's the journal entry. So this is an example of an inventory cost. It's a cost definitely related to inventories, but we wouldn't capitalize it. So costs that costs include are all costs of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. The costs to exclude are abnormal costs incurred as a result of waste of materials, any storage costs, unless they're required as part of production, and then all administrative overhead costs. Those last three there, those don't get capitalized. We expense those. So let's go. Okay, so in this example, it's a brilliant business idea. So in this example, we have kitten mittens that are going to be produced. So we're going to go through this example, and at the end of me reading this, it would be a good idea for you to pause and see if you can identify what expenses we'd include and what we'd exclude from the capitalization of inventory and what would be expensed in that period. In 2023, Charlie produced 900,000 finished kitten mittens and tossed out 1,000 kitten mittens. For the finished kitten mittens, the yarn costs were $900. Charlie paid Frank $180 to make the mittens, and production overhead costs were $100. The 1,000 scrapped kitten mittens, attributable to an abnormal waste event from an unfortunate mishap while playing the game of games, had a total production cost of $30, $10 in raw material costs, and $20 in conversion costs. These costs are not included in the $900 raw material and the $180 total conversion costs from Frank of the kitten mitten. During the year, Charlie spent $10 for Mac to drive the yarn to his house, and $500 for storing the finished goods in Patty's pub. Charlie does not have any work in progress inventory at the end of the year. What does Charlie include in inventory in 2023? Cost should Charlie expense in 2023? All right, so pause it here because I'm going to go over the answer in just a sec. All right, so hopefully you did well. Some of these things are pretty obvious that we wouldn't include or we would include. All right, so the yarn of raw materials that we have, the yarn of raw materials, $900, we would include that. Obviously, that's like the core of the inventory that we have. And Frank, we'd call direct labor. Frank, he did some of the knitting on that. So it was $180. And then we identified specifically, I identified in the prior slide, it said production overhead. There were production overhead costs of $180. In the prior slide, I mentioned there were production overhead costs of $100. So if we go here, the yarn costs were here, production overhead costs here, and then we paid Frank $180 here to make the mittens. The transportation of raw materials we capitalized. So we paid $10. During the year, Charlie spent $10 for Mac to drive the yarn to his house and $500 for storing the finished goods. So we spent that $10 for Mac to drive the yarn to his house. So we would capitalize the yarn, Frank's direct labor, the production overhead, the transportation of raw materials. These would amount to $1,190 in total inventory costs. So what that is that's the amount that would be kept on the balance sheet as an asset, even though we spent this money. We spent the money, but our total balance and assets wouldn't change because we're just transforming assets. We didn't lose the net balance, right? Certain costs we would expense and we would show that we don't have a resource anymore. So the abnormal waste from the game of games, we would expense the $30 associated with that. And the storage of the finished goods, we would actually expense that because it wasn't related to the kitten mittens. There's no storage aspect of mittens for cats that is necessary or required. Anyway, we defined inventory as a probable future economic benefit associated with the goods that are either purchased or created in a business and intended to be sold into the future. We went over the standard journal entries and we went over capitalizing versus expensing journal entries and what would actually go into each one of those in the inventory production and storage and creation process.